Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, May 15th, 2026, and we're closing out a week that's been dominated by bond market turbulence and inflation concerns. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story this week has been the global bond sell-off that's intensifying as we speak. We're seeing yields rise across the board, driven by persistent inflation worries and the recent spike in oil prices. The dollar is rallying toward its best week since March, which tells us the market is pricing in a higher probability of Federal Reserve rate hikes. What's particularly concerning is that this isn't just a US phenomenon. We're seeing what the Financial Times is calling the Great Global Bond Freakout, with gilts falling in the UK and bond pressure across Europe. The connection to rising oil prices is critical here. Trump's announcement that China agreed to buy US crude following the DSC talks pushed oil prices higher, and bond investors are interpreting this as another inflationary pressure point. When you combine this with the bond market essentially hiking rates ahead of Kevin Warsh taking over as the Fed's new chair, you're seeing a market that's nervous about the inflation trajectory and isn't waiting for central banks to act.
That's painting quite a challenging picture. How are equity markets responding to this bond market pressure?
Equities are caught in an interesting position right now. We've got stocks trading near all-time highs, but there's this underlying tension. The S&P 500 just hit a new all-time high, yet we're seeing what Goldman Sachs calls a rare signal that historically has specific implications for future returns. Warren Buffett's preferred valuation measure, which he's called probably the best single measure of where valuations stand, is sounding an alarm for Wall Street. The headlines are literally asking whether now is a bad time to invest, given how extended we are. But here's what's interesting from a trading perspective. We're seeing selective strength in certain sectors. Bill Ackman's Pershing Square just disclosed a new Microsoft position in Q1, betting on AI ambitions, which shows that smart money is still finding opportunities, even at these levels. We also saw Magnum ice cream stock soar 18% on private equity takeover reports. And there's continued interest in the Cerebras IPO, despite the stock falling after its blockbuster debut. The market is bifurcating between momentum plays and value concerns.
So we're seeing this tension between high valuations and selective opportunities. What's your technical read on the major indices?
Looking at the technicals, the S&P 500 is in a precarious position. We've broken to new all-time highs, which is technically bullish, but we're seeing divergences in momentum indicators that suggest this rally is running on fumes. The index is facing resistance around the 5,850 level, and if bond yields continue rising, I'd expect a pullback toward 5,700 support. The Nasdaq is even more extended, trading well above its 50-day moving average. Tech has been the leader, but with Microsoft and other megacaps that stretch valuations, there's limited upside from here without a consolidation period. I'm watching the 19,200 level on the Nasdaq as critical support. The Dow is actually showing relative strength, which makes sense given its value tilt and the rotation we're seeing out of growth. The Dow is holding above 40,000, and as long as it stays above 39,800, the trend remains intact. But across all three indices, the rising bond yields are the key risk factor. If the 10-year Treasury yield breaks above 4.5%, I think we see a meaningful correction across equities.
That selectivity is going to be key for navigating these conditions, given these valuation concerns and the bond market pressure. What does this mean for traders looking at the week ahead?
For traders, the focus needs to be on risk management and sector selection. The broad market rally is getting tired, so chasing momentum here is dangerous instead. Look for sectors that benefit from higher rates and inflation concerns. Energy is an obvious play given the oil price spike, and we're seeing that with Trump's China crude deal providing a fundamental catalyst. Financials should benefit from higher yields, assuming we don't get a full-blown credit crisis. On the short side, or at least underweight side, I'd be cautious on high multiple tech stocks and anything that's been a momentum darling without earnings to back it up. The Cerebras situation is instructive, blockbuster IPO, but the stock fell because investors are experiencing Nvidia fatigue and questioning whether the valuations make sense. We're also seeing more volatility in smaller caps and SPACs, which tells me risk appetite is becoming more selective. The key is not to be a hero here. If you're long, tighten stops. If you're looking to add exposure, wait for a pullback and keep a close eye on that 10-year yield. It's driving everything right now.
Steve, let's shift to the economic calendar. We've had a busy week of data releases. What's the picture looking like from the macro perspective?
Thanks, Robert. This week has been relatively quiet on the major economic releases, but what we did get was significant. Earlier this week, we received the April CPI report, which came in hotter than expected at 3.2% year-over-year for headline inflation and 3.8% for core, which excludes food and energy. That was 1/10 of a point above consensus estimates and is a major reason we're seeing the bond market react so negatively. The month-over-month core CPI was 0.4%, which annualizes to well above the Fed's 2% target. We also got producer price index data on Tuesday, which showed wholesale inflation rising 2.8% year-over-year, again above expectations. This is feeding through to consumer prices with a lag, which means the inflation story isn't over. Retail sales data from Wednesday showed consumer spending remains resilient, up 3% in April, but when you adjust for inflation, real spending growth is essentially flat. Looking ahead to next week, we've got some critical releases. The preliminary PMI data comes out on Thursday, which will give us insight into manufacturing and services sector activity. The Fed will also release minutes from their last meeting on Wednesday, which traders will parse for any hints about the rate path given this recent inflation data. Housing starts and building permits are due Tuesday, and those numbers matter because housing has been one of the sectors most sensitive to higher rates. Initial jobless claims next Thursday will be watched closely to see if the labor market is finally cooling, which is what the Fed needs to see to justify holding rates steady or potentially cutting later this year.
Those inflation numbers certainly explain the bond market's reaction. Are there any other data points that could move markets significantly?
Absolutely. The University of Michigan Consumer Sentiment Survey final reading comes out next Friday, and more importantly, it includes inflation expectations data. If consumers expect higher inflation ahead, that becomes self-fulfilling as they demand higher wages and accept higher prices. We're also getting durable goods orders on Tuesday, which is a leading indicator for business investment and manufacturing activity, given the strength in industrial production we saw last month. Any weakness in durable goods would be concerning. The other wildcard is the ongoing Treasury auction schedule, with the government needing to fund deficits and the Fed no longer buying bonds through quantitative easing. These auctions are critical for gauging real demand for U.S. debt. We've seen some weak auctions recently, which is contributing to higher yields. Next week has a 20-year bond auction on Wednesday that could be telling if demand is weak and yields spike further. That's when equity markets really start to feel pain. The correlation between bond yields and equity valuations is direct. Higher yields mean lower present values for future earnings, which compresses PE multiples. We're already seeing this play out in real time, and if yields continue rising, the valuation pressure on stocks intensifies significantly.
Those are critical releases to monitor. Now, Lizzie, let's talk crypto. What are the trends shaping up for next week in the digital asset space?
The crypto market is at an interesting inflection point, and the key catalyst everyone's watching is the Clarity Act progression through the Senate. Bitcoin hit $82,000 this week when the Clarity Act cleared the Senate Banking Committee, which represents major regulatory progress. However, we're seeing BTC struggle to maintain momentum above $80,000, and there's been a concerning outflow of $635 million from Bitcoin ETFs as the price slipped under that key level. The sentiment is cautiously bullish, but there's clear resistance. Technically, Bitcoin is still trading below its 200-day moving average, and analysts are pointing to rising treasury yields as a headwind for institutional adoption. The key levels to watch are $80,000 as support, and if that breaks, we could see a retest of $76,000. On the upside, if BTC can break cleanly above $82,000, the next target is $85,000. What's encouraging is the institutional activity. JP Morgan increased Bitcoin ETF exposure in Q1, led by BlackRock's IBIT, which shows continued institutional adoption despite the recent volatility. For next week, traders should watch the Clarity Act vote closely. If it progresses through the full Senate, that's a major catalyst that could drive Bitcoin toward that $85,000 level and lift the entire crypto market.
What about Ethereum and Solana? How are they positioned?
Ethereum is facing headwinds, and I'm bearish to neutral on Ether for the near term. JP Morgan just issued a warning that Ethereum upgrades may not be sufficient to lift Ether prices, which is a significant red flag given JP Morgan's influence with institutional investors. Ethereum has been notably absent from the recent altcoin surge headlines, suggesting relative weakness compared to other major cryptos. There's less institutional focus on Ether right now, and it's likely to underperform Bitcoin and Solana in the coming week. I'd avoid Ethereum until we see clearer positive catalysts emerge. Solana, on the other hand, is strongly bullish. This is where the momentum is in the altcoin space. The Dartmouth Endowment just invested in a Solana ETF, bringing their total crypto exposure to $14 million, which represents major institutional validation. Technically, Solana bulls are testing the 98 level, and if that breaks, the next target is $117. We're seeing strong DeFi activity on Solana-related projects with Hyperliquid leading 24-hour gains. The ecosystem growth is real, and Solana is winning the Layer 1 competition against Ethereum right now. For traders, Solana is the momentum play in crypto. I'd look to enter on any pullback to the $90 range with stops below 88 XUX. The risk-reward is favorable here, especially compared to Ethereum.
What about institutional versus retail positioning in Bitcoin specifically?
That's a critical distinction right now. Institutional investors are still accumulating, as evidenced by JP Morgan's increased ETF exposure and the continued inflows into BlackRock's IBIT product, despite this week's overall outflows. Institutions are taking a longer-term view, positioning for regulatory clarity and treating Bitcoin as a portfolio diversifier and inflation hedge. They're less concerned about the day-to-day volatility around $80,000 and more focused on the 12 to 18-month outlook. Retail, on the other hand, is more sentiment-driven and reactive to price action. The $635 million in ETF outflows this week likely represents retail profit-taking after the run-up to $82,000. Retail tends to buy tops and sell bottoms, and we're seeing that pattern play out. What's interesting is that Bitcoin is actually trading at a discount on Coinbase compared to other exchanges, which some analysts interpret as a bearish signal, suggesting a potential retest of $76,000. But that discount could also represent a buying opportunity if you believe institutions will continue accumulating. The divergence between institutional accumulation and retail distribution is classic late-stage consolidation before a breakout. My read is that institutions are right here. The regulatory progress with the Clarity Act is a fundamental game changer, and once retail sentiment turns positive again, we could see a sharp move higher. But in the near term, expect choppiness around $80,000 as these two groups battle it out.
That's a comprehensive look at where we stand across markets, economic data, and crypto as we head into next week. The bond market is clearly the story, with inflation concerns and rising yields creating headwinds for risk assets. We're seeing selective opportunities in equities despite extended valuations. Critical economic data releases ahead that could move markets significantly, and crypto at an inflection point with regulatory progress as the key catalysts. Thanks to Lizzie and Steve for their insights today. Remember, do your own research and consult with financial advisors before making investment decisions. If you found this discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market analysis. I'm Robert, and we'll see you next time.